Ladies and gentlemen, I did have a really awesome intro planned, but today I can't in good conscience release this video without paying homage to Warren Buffett. My entire worldview of long-term investing is thanks to Warren. The reason I remain perpetually bullish and optimistic is because of Warren Buffett. He shaped my view on investing, finance, and so much more beyond that. Warren is truly a role model. He never flip-flopped, owned his mistakes, took the wins gracefully, donated so much money to charity, remained loyal to his wife, family, and ideals. For all of that, Warren, I say thank you and enjoy retirement when it happens. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks retreated from a historic run of gains on Monday as Trump's new tariff threat revived trade war worries in the wait for a Federal Reserve policy decision. The Dow and the S&P 500 snapped its 9-day winning streak today, and there was the theme as to the selling. You could see the big names in every single sector led the selling. The smaller names in those sectors kind of outperformed, and that is why we had the day we had today. For example, Berkshire Hathaway after its earnings down 5%, but the broad financial space kind of green. You could see here that tech was a complete dumpster fire led by selling, and Nvidia, specifically hardware, didn't follow suit. However, we did see that here in technology services and software with Microsoft and Google kind of flat, and the broad market outperforming. You can see, for example, in health technology, Eli Lilly, right? The big name there was red. ExxonMobil, Chevron were both red. Tesla in consumer durables. So we saw selling in some of these bigger names, outperformance in some of the smaller names, but it was far and few between. This is what the market looked like when you look at the sector view in aggregate. The S&P 500 was down 0.62%. So it wasn't like a violent red day. It was just a red day. And at one point we were nearly break even on the day. It was just, a stock standard red day after pretty much 9 days of green after green and about a 14% rally off the lows we saw after the 90-day tariff pause. The best performing, sector you could say was gold, up nearly 3%. The only two green sectors was communications and industrials. And you could see here that what outperformed the SPY was the defensive names. Look at staples, real estate, utilities, healthcare. So there is this defensive posturing along with gold when you look at outperformance relative to the S&P 500, and sort of the sensitive names when you look at technology, financials, materials, discretionary. They all underperformed the S&P 500, and that is why we got the trade we did today. However, mid-cap growth was the only factor segment that was green today, and it was just ever so slightly green. The worst performing sector was actually large cap value right here, but we saw selling across the board. Value, core, growth, small, mid, large cap. We also saw selling across the globe. North America, South America, you could see Australia kind of red. Europe was mixed. Asia was the only green geography year today, or relatively stable geography. And all of this came down to Trump's tariff. This sort of just reignited trade war concerns. Trump ordered a 100% tariff on foreign-made movies to save dying Hollywood. Apparently, countries like Europe, like Asia, like Australia are subsidizing the movie industry to make movies in their country. Trump is now putting a 100% tariff on foreign-made movies. So I don't know how this is going to work. Are they going to look at like total box office sales and then tax them that amount if it's not made in the US? I don't know what that looks like. We've got to see the details of this very interesting strategy. This was something I didn't even know was going on until Trump announced it. I guess what also did help market sentiment here today was the ISM services. I think this is probably the reason why we went down like 1.5% after today's trade, because ISM services dropped and we actually beat expectations by a lot. We reported 51.6, which is expansion against the consensus of about 50.6. We also saw the composite PMI. While it did miss consensus expectations, it did come above the 50 mark. But ultimately, the ISM services PMI is the major data point you want to be looking at. This is the big one that Wall Street looks at when it comes to ISM manufacturing data. We also got a couple of bond auctions today. All in all, the economic data was really good. A couple of other market movers, especially when it came to earnings. Ford reported their earnings. They beat on top line, beat on bottom line, pulled their guidance, and they said tariffs could have significant impact on the bottom line. And that is why the stock was down here today and in the after hours. Palantir released their earnings as as well. They beat on revenue. EPS actually came in line. US commercial revenue increased 71% on a year-over-year basis. They raised their Q2 and full year guidance. And to be honest, this was just another business as usual quarter. The reason why the stock was actually down here in the after hours is because the beat rate percentage is narrowing every single quarter, especially with EPS coming in line. So yes, revenue growth, the beat rate is slowing, it is decelerating, and we are starting to see this company mature, and that is why the stock was down 5%. Hims & Hers Health was down 4% here in the after hours, but up 2.6% today, and that is because it beat on the top line, beat on the bottom line. Revenue grew 111% year over year. It reaffirmed its full year revenue and raised its EBITDA guidance for the full year, and also introduced 2030 guidance, right, for $6.5 billion. And they used the word at least. So this is like a minimum figure. It looks like the stock was down in the after hours. I don't know why. Maybe it has to do with valuation, trading at 47 times PE. Nonetheless, great quarter from both of these companies, Hims and Palantir. Like, these are companies firing on all cylinders. It's just maybe the valuation that's gotten a bit ahead of them, but nothing fundamentally wrong with the business of these two companies. I mean, if it looks like a weed and it grows like a weed, it's probably Hims or Palantir. And guys, I'm going to do an earnings breakdown in depth for both of these companies, Hims and Palantir, on my FinFluential Media channel at FinFluential Media. There's going to be a link in the description, a link in the pinned comment. So please go ahead, subscribe, and you'll get those updates about an hour or two after this upload right here. And then in terms of the big names, Berkshire Hathaway was down 5% today. And that is because, number one, Warren Buffett did retire. But number two, operating profit for the company did fall 14% on reduced insurance underwriting as well as currency losses. The company does have $347 billion in cash. It owns about 4% of the T-bill market. Outstanding, absolutely insane. But revenue and EPS did sort of miss expectations ever so slightly. Nonetheless, it does feel like the majority of the selling is because of Warren leaving. However, I think the stock will do very well in the long term. And then for everything we got today, we had 2,200 advances, 4,000 decliners. We saw net inflows in both the New York Stock Exchange and the Nasdaq 100. And market momentum continues to remain robust. The 5-day, 20-day, and 50-day moving average continue to be above the 50% mark. While it did slow from what we saw last week, it is still above the 50% mark, which is really, really good. And when you look at the longer term moving averages, they actually did see slight improvement, especially when you look at something like the 100-day right here. All in all, things look rather robust for us to continue moving higher, especially if we go retake some of these longer term averages. Now, looking at the charts, you can see that generally speaking, it was red across the board. The SPYs, the Qs, the RSPs, mid caps and small caps, with outperformance coming from mid caps, and we're looking a bit red here in the extended hours. But again, after the massive rally, you could see here that we've had off the lows. If we actually just measure on a peak to trough basis to where we close, we're looking at like a 17% run off the lows. Like, some of the, I guess you could say, volatility is just a bit of price digestion, completely normal after a 20% run in just a couple of weeks. So I wouldn't even pay too much attention to what's happening now. Even if we were red for the entire week and we pulled back another 3 or 4% from where we are, it would still be completely normal and relatively healthy. We saw Europe gained ever so slightly. Same with China. Volatility did tick up, but we're in slight backwardation. Nothing to be concerned about right here. And we're actually below the 30 mark in the VIX. And that's telling us that volatility has abated significantly. The 2-year, 10-year, and 30-year yield did gain. The dollar did fall, very interesting, and as a result, treasuries did fall ever so slightly, both shorter term and longer term treasuries. Bitcoin outperformed equities as a whole, so there is still that risk on environment in Bitcoin. Gold was up 2.8%, silver up 1.5%, WTI fell. So yeah, just positioning here into safe havens, and it does look like the bulls in Bitcoin and with M2 money supply are looking at that and saying, hey, they still want to get long Bitcoin. I am still a Bitcoin bull, especially now into the end of July. But let's actually talk about the S&P 500. Now, the core wall, as you guys know, this blue line right here didn't move up. In fact, we got no changes. And for those of you that are new here, above the yellow line, we are bullish. Below the yellow line, we are bearish. This is called positive gamma. This is called negative gamma. And the reason why we remain bullish or bearish below these lines is simply because of how option dealers position themselves. It's based on the options market. However, when we do get to the top of the range and we don't actually see the call wall move up significantly, that probably means we will see a little bit of downside. This is actually what we said on Friday. We said if we don't break above the 5,700 position on Monday, we probably will see a little bit of downside into the start of the week. That's exactly what we're getting. We didn't go above the 5,700. We're getting a little bit of downside for the rest of the week. And until we actually go ahead and retake the 5,700, do expect us to continue to probably drift lower, but for us to put in a higher low relative to this probably low right here. So 54.30 is probably the level where you want to probably start getting long, and that would be a low right here, higher low, higher low. You put in a higher low, that would just signal trend continuation, especially if you go ahead and retake this high right here and then these highs. So all in all, I am expecting a week of digestion. Like I said, guys, we had a stellar run, but that week of digestion can become a bull run if we go ahead and break the 5,700. Very similar situation on the Nasdaq 100. You can see we got to the top end of the range, pulling a bit back. We want to retake the 20,300. It's actually the 20,294, as you can see right here. And this would take us above this level right here. That is ultimately the level we want to capture. But this does look like a lower high, relatively speaking, to this high right here. But as long as we put in a higher low, that should mean trend continuation. Not super worried with the price action we're seeing today. I am expecting a little bit of a weaker week. Again, especially after the rally we've seen, that would be completely normal. And we do have some market moving events. And I think if the market is going to move, it's going to be after the Fed decision on Wednesday. So we might see a little bit of weakness, and then Wednesday we'll make the next move. But ultimately, the 20,300 for the Nasdaq and the 5,700 for the S&P 500 are the two levels we want to watch. The level you want to watch for gold is probably this level right here, the 3,200 level. You can see we bounced off very, very strongly. And if we actually sort of just make like a rectangle, I guess you could say that this is probably the place where you want to buy if we do get back into this level. Gold has been notoriously hard to predict. I mean, did anybody actually think we were going to reverse there? I personally didn't. I thought we were going to go lower. So gold, very, very difficult to determine what's going to happen next. The strength is on the clear side of the bulls. And as long as we have this tariff uncertainty, gold will do very, very well. Ultimately, what you want to do with gold is buy dips, have tight stops, because you're going to get days like this as long as trade deals are not announced. But what the bulls need to do now is actually retake this high. That is a big, big ask for the gold bulls. If they don't retake this high, this is going to be a lower high, along with, I would say, an equal low relative to what we did right here. So gold sort of in this limbo position where it looks bullish, but there are signs that are pointing to bearish activity. What isn't pointing to bearish activity is Bitcoin. Now, we've said for a while now that Bitcoin is going to follow the M2 money supply line higher. We were looking for a little bit of a pullback. You can see that we did get that in the Bitcoin price about there. I would say that all pullbacks that we do get in Bitcoin are opportunities to get long, take advantage of the move higher that will come. If we actually take a measured move, peak to trough to where we are right now, Bitcoin is up about 24% from those lows. It followed equities higher. I think we are going to go ahead and retake all-time highs. Not without volatility. We will get volatility, but we're going to go ahead and retake those all-time highs and continue to march higher in Bitcoin. M2 money supply is on our side. And guys, let's talk about sentiment. This is the weekend poll, and the question I posed was, how are you feeling about the S&P 500 this week? And the results were very, very interesting. Now, first, the 20% of you were neutral, but the vast majority of you guys picked sides, and it was even and down to the T. 40% of you were bearish, 40% of you were bullish, and this sets us up really, really nicely for this week. We are at a key critical level. We're at about the 50% retracement, peak to trough after the Liberation Day sell-off. And where we go next will be determined on who has more convictions. Is it the bulls? Is it the bears? Time will tell. However, Wall Street analysts are actually very, very bearish on the market. They have slashed their estimates since the start of the year. You could see a lot of these estimates were well above the 6,500 mark for a year-end S&P 500 price target. Now the majority of them are below the 6,000 mark. Some of them still above, as you can see here, Morgan Stanley, CFRA, Fundstrat. They're still very, very bullish. However, we have seen a tangible deterioration in overall sentiment and end-of-year price targets. However, I do think the people that are going to win are those that are in this camp right here, the mid 6,000 $1,000 level, simply because earnings has been very, very good. We were expecting earnings growth this earnings season of about 7.8%. Right now, we're reporting about 13% in earnings growth. And if you actually exclude the energy sector, you're looking at about 14.9, call it 15% in earnings growth. 325 companies have reported earnings, guys. 74.5% have reported above analyst expectations. And the leading sectors in earnings is healthcare, comm services, and technology. Very big sectors leading the charge. You love to see that. Ultimately, if we can keep up this momentum in Q2, Q3, Q4, markets will rally higher, potentially to all-time highs and beyond. And the truth is, we just recently have come off a breath thrust. From February 19th to April 18th, that 4-week period, the S&P 500 experienced an 18.9% drawdown. 12.2% of the drawdown occurred over the last 3 weeks of that time frame. As of May 2nd, the S&P 500 has rallied 14.3% off those lows. Since 1950, there have been 20 previous occasions where a 10% sell-off within a rolling 21-day rally was followed by a 10% rally in the following month. And what has ensued is very, very positive returns. Average return 1 month later after that triggers essentially a breath thrust where you go down very quickly and up very quickly in a very, very short time period is 2.58% return 1 month later. 3 months later, in excess of 5%. But look at the 12-month returns, double digits, low 20s returns. And this is why when you get these sharp pullbacks and a quick retracement in the markets, you want to get long, and you want to get long very, very quickly, because ultimately that does lead to higher prices. But everything is going to be dependent on the macro and tariffs. And right now we're looking at GDP Q2 growth of about 1%. So nothing is flashing recession. However, we are eerily close to this negative line, and we do actually have some of the blue chip consensus. These are like big banks saying that we could actually see negative GDP growth. If we get a second quarter of negative GDP growth, guys, that is a technical recession, and the Fed is in quite the dilemma. Bond traders are betting on rate cuts by December, as well as inflation higher in a year from now. The 1-year inflation swaps have soared from about 2.5 to nearly 3.25%, at the highs just above 3.5%. So inflation expectations have increased about 100 basis points from these lows. At the same time, rate cut expectations have also increased. The 2-year yield sitting at about 3.8%, and that's an implied rate cut of about 80 basis points through December. Not a good place to be in, where the market expects you to cut and inflation ramps up. However, what's ultimately going to matter this week is the Fed's decision. We get the interest rate decision and the Fed press conference. Now, the expectation is for a 4.5%. Now, the expectation is for a 4.5% Fed funds. In other words, leaving it unchanged. But what ultimately is going to matter more than the actual interest rate decision, because I think they're going to leave it unchanged, is the press conference and Jerome Powell's commentary for future rate cuts. We also do have some other market movers, the balance of trade tomorrow, exports and imports, and then we get initial jobless claims here on Thursday. So a fairly light week of data, but a jammed packed week of earnings. Tomorrow on Tuesday, we get D-Dog, Race, and Celsius. Ferrari, ticker symbol RACE. They all report earnings before the open. After the close, we get AMD, SMCI, Arista Networks. Guys, these are heavy AI plays, and that's going to determine where the tech sector goes for the rest of the week. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.